The untold story of the 2008 U.S. financial crisis, unveiling the secrets that shook the nation. Step into the shadows of history as we delve deep into the events that unfolded in 2008, triggering the largest financial crisis the United States had ever witnessed. Buckle up for a captivating journey through the complexities of the crisis, where greed, flawed policies, and a perfect storm of economic factors converged. Unveiling the hidden truths, this video will expose the underlying causes, the catastrophic consequences, and even shed light on how a select few managed to amass fortunes amidst the chaos. Get ready to witness the untold story that will keep you glued to your screen until the very end. The housing bubble bursts. In the early 2000s, a housing bubble grew exponentially as lenders offered subprime mortgages to borrowers with poor credit. The illusion of endlessly appreciating home values led to a bubble that eventually burst, plunging the nation into crisis. The domino effect. As homeowners defaulted on their mortgages, financial institutions that held mortgage-backed securities faced severe losses. This set off a chain reaction, as banks faced insolvency, triggering a domino effect throughout the economy. The collapse of Lehman Brothers. In September 2008, the unthinkable happened. Lehman Brothers, a prestigious investment bank, filed for bankruptcy. The collapse of this Wall Street giant sent shockwaves through the global financial system, intensifying the crisis. Government intervention. To prevent a complete meltdown, the U.S. government intervened with massive bailouts, injecting billions of dollars into troubled financial institutions. This unprecedented move aimed to stabilize the economy and restore confidence. The Great Recession. The repercussions of the crisis extended far beyond the financial sector. Unemployment soared, businesses shuttered, and the housing market plummeted. The United States entered the Great Recession, a period of economic turmoil that lasted for years. Regulatory failures. The crisis exposed significant flaws in the regulatory framework. Institutions deemed too big to fail enjoyed risky behavior with little accountability, while oversight agencies failed to detect or prevent the impending disaster. Too much debt, too little oversight. Financial institutions took advantage of lax regulations and engaged in complex financial derivatives such as mortgage-backed securities and collateralized debt obligations. These intricate financial products, coupled with excessive leverage, amplified the crisis. Human greed and moral hazard. Financial incentives drove individuals and institutions to take excessive risks, guided by short-term gains rather than long-term stability. The concept of moral hazard, where actors take risks with the knowledge that they won't bear the full consequences, played a significant role. Foreclosure crisis. As homeowners defaulted on their mortgages, millions faced the heart-wrenching ordeal of losing their homes through foreclosures. The human toll of the crisis was immense, leaving countless families in despair. Global impact. The interconnectedness of the global economy ensured that the effects of the crisis were felt far beyond U.S. borders. International markets tumbled, countries faced recessionary pressures, and confidence in the financial system was severely shaken. Financial regulation reforms. In the aftermath of the crisis, governments worldwide implemented sweeping reforms to strengthen financial regulations. The Dodd-Frank Wall Street Reform and Consumer Protection Act aimed to prevent a repeat of the disaster by imposing stricter oversight. The winners amidst the chaos. While the crisis caused immense suffering for many, some astute individuals managed to profit from the chaos. Hedge fund managers, who bet against the housing market, reaped astronomical returns, showcasing the dark side of the financial world. Lessons learned. The 2008 crisis highlighted the need for enhanced risk management, transparency, and ethical behavior within the financial industry. It served as a stark reminder that unchecked greed and systemic flaws can have devastating consequences. The role of government. The crisis underscored the critical role of government in safeguarding the economy and protecting the interests of its citizens. It prompted calls for stronger regulations, increased transparency, and improved oversight to prevent future crises. Building a resilient future. Over a decade has passed since the 2008 crisis, and the scars are still visible. However, the experience has paved the way for important reforms and a collective determination to build a more resilient financial system. Stricter lending standards, stress tests for financial institutions, and improved risk management practices aim to mitigate future crises. As we conclude this gripping journey through the 2008 U.S. financial crisis, we are left with a profound understanding of the forces that brought the nation to its knees. It serves as a stark reminder that the pursuit of wealth without accountability can have far-reaching consequences. Let us strive for a future where greed is tempered, regulations are robust, and the lessons of the past guide us towards stability and prosperity. Remember, the world of finance is a complex web of intrigue, where fortunes can be made or shattered. It is up to us to remain vigilant, demanding transparency, and holding those in power accountable. Stay informed, and together, let us shape a financial system that serves the needs of all, fostering trust and ensuring a more equitable future. If you found this video insightful and thought-provoking, we invite you to like and subscribe to our channel. By doing so, you'll stay connected to our future content that explores the fascinating realms of history, economics, and societal events. Together, let's delve deeper into the stories that shape our world and empower ourselves with knowledge.